People are even borrowing money to get into the stock market. Option has become the new cult. Retailers are losing money. And why they have lost big money? Basic reason is of not having a trading psychology. It is the only way you can survive in this market. This whole highlight of the talk is only for the people who are trading into the market. If you want to be a good trader, the best thing you can do. Hi friends, this is Ashish Bahety. Basically, I'm a chartered accountant by qualification. But while doing my CA, I realized very immediately that audit and taxation is not my cup of tea. And immediately I thought, even while doing the CA, that I wanted to get into the investment banking side. So I pursued my career accordingly. Along with the CA, I completed my CS, law, and other international degrees so that I can get into a investment banking firm. But to my fate, I cleared in 2008. That was the worst time to clear and get into an investment banking side because of the Lehman Bank crisis. Luckily, because of my niche into the financial markets, I was able to secure a good job in one of the leading investment bank. That was JP Morgan Chase. Immediately after the Chase, I went to get a job into the front-end trading desk, that is a proprietary trading desk. Did a 1-year sprint there and 1-year sprint almost with JPM Chase. I immediately moved to set up my own shop, moved to Singapore to start a trading desk in India, which was supposed to trade all the international markets. I and a couple of my friends, we started this, but immediately when we quit the job and set up to move our shop, I was almost 8 months in Singapore, doing the entire research, setting up the setup, arranging the funds. Immediately when I returned back to India, I realized there was a change in government regulations into the FEMA and FERA laws, and whatever we were planning to do, that somehow become not legal, or it didn't turn illegal, but it was not illegal also. So it came into the gray zone, and we immediately decided that, okay, since it's a gray zone, we'll not be doing this. Irrespective of the fact that it was very profitable, it was very lucrative to trade those instruments. It took us 2 years to figure out how to trade Indian markets, because I in my previous job I was trading international markets. But to my surprise, whatever I've learned there, it helped me. And whether it's international markets or Indian markets, the basic fundamentals remains the same. The trading is 70% psychology and 30% only your technical analysis, fundamental analysis, quantitative analysis, whatever you do. If you're doing a discretionary trading, 70% of your trading is your psychology. I'll highlight a very important point. I've worked on both institution side and the retail side. See, when I started my career 2008, there was hardly any YouTube videos available on technical analysis. There was hardly any material available. But when it comes to technical analysis, right now, there's ample of data available. There is, 2008 Bloomberg terminal was very expensive and the data flow was very expensive. Today, the data moves very fast. You have some of the news flashes which comes even before Bloomberg terminal, it comes on Twitter. Okay, so now retailer don't have that problem that they are less accessible to data, or the institution have more access to data. But why is that? Still, retailers are losing money. Technical analysis is pretty easy. When I say it's pretty easy, compared to any other science, compared to any other form of education, if you see technical analysis, one can easily get trained in technical analysis in 7 days to 30 days. If I compare it to engineering, doctor, CA, or any other profession, technical analysis is relatively a much easier analysis or much easier form of study. Okay, chart patterns are very easy to understand. Despite it being so easy to understand, why traders are losing money? Why the chart patterns fail? Why people are not making money, or why every technical analyst is not making money? That is my question. And that is what I'm going to be answering today. So stay tuned. See, when it comes to technical analysis have a lot of similarity with economics. In economics also, what we do, we study the past data, we study the behavior of the people, their spending, and we try to predict the futures. Whether it's an economist of a country, economist of a bank, or economist of a who's forming a GDP or some other World Bank economist, he's doing the same thing. He's taking their past data, making a hypothesis, and making analysis of that data and predicting the future. Obviously, there always going to be some probabilities in that. No data or no hypothesis is 100% certain. Similarly, in technical analysis, also, we study the past data and we try to predict what may happen in the future. But there always going to be outlier. There always going to be chances when the data will not going to work. So comparing technical analysis with other form of education, it is much simpler and much easier to understand. Yet people are not making money while using technical analysis. What is the main reason? To put it in a very, very simple word, or to decode it for you in a much simpler word, I can say market moves only 20 to 30% in trend. Market stays up to 70% in a sideways market. Okay. And if a market stays in sideways market, it means it is not doing anything. It is pretty flat or it is not going anywhere. Only 20 to 30% it is trending. And again in trending, it can be uptrend and it can be downtrend. There are hundreds, if not thousands, of indicators which are available. For an uptrending market, there are hundreds of indicators which are available for downtrending market, or I'll say trending market or a breakout trading, there are hundreds of indicators available. Similarly, there are hundreds of indicators, or even, I'll not be exaggerating if I'll say thousands or 10,000 of indicators available. If I do the permutation combination, there are thousands of indicators available for sideways market. The problem with technical analyst is they read one, or they understand, or they study one pattern and they try to fit it into all market. So like you have one pair of clothes which you're using it for winter and as well as summer. Okay. And then you're complaining that, okay, something which was working so well in summers is not giving you any protection in winter. You have to understand, in a sideways market, whatever is your study will never going to work if for a trending market. So any indicator which works beautifully on a trending market will never going to work on a sideways market. And any indicator which is on a sideways market, for sideways market, will never going to work for an uptrending market or downtrending market. So first and foremost, you have to understand where is the market, whether the market is trending or not trending, whether the market is sideways or it is consolidating. Okay. So if it's a consolidating or a sideways market, you have to use indicators which are meant for that. And if it is a trending market, then you use any trending market indicator, you'll always going to make money. But the problem with people is, people have learned technical analysis. They have learned one or two or 4 or 5 indicators patterns, and they use it for all market, all strategies, all time frames. That doesn't work. So the best way is you do a analysis on a higher time frame, understand whether it's a trending and non-trending on a higher time frame, then come to down smaller time frame and try to put that analysis. The second biggest problem with the retail side traders is the trading psychology. Trading psychology contributes, as I said in the start of my talk, that it contributes 70% of your success is dependent on trading psychology. When I'm saying 70%, it can be even 90% also, depending on people to people. Okay. But your whole analysis don't contribute more than 30%. That I'm very sure. So trading psychology is very important. Okay. When I'm saying psychology is very important, it's only meant for trading. Okay. For investment is pretty easy. Okay. Investment is not tough in markets. The tougher part is trading. Why I'm saying investment is easy? See, if I have to give you an example, how much it will going to rain. I'm from Pune, so I'll take the example of Pune. How much it will going to rain in Pune for one calendar year? It is pretty easy to predict, like the dams will be filled 90% or 95%. But if I may ask you, how much it will going to rain on 15th of August? It is pretty difficult to answer that question, or to give you a precise answer, how much it will going to rain on 15th August. So trading is exactly that question. How much it will going to rain on 15th August, or how much HDFC Bank or Maruti will going to move tomorrow. That is trading. The HDFC Bank or Reliance or all these top line or Nifty and Bank Nifty, they're all going to perform very good in 5-year or 10-year period. But when it comes to trading, it becomes very difficult to predict the smaller or the micro trends. The broader trend is very easy. The problem with trading is it is very difficult to have the go away with your biasness. There are more than 20 type of biasnesses which traders has to deal with every day. To cover some of the very important biasness is what I'm going to talk about is which relates to the stop loss. It is also known as Concord fallacy. So Concord fallacy is also known as the sunk cost fallacy. What is sunk cost fallacy or the Concord fallacy? It is very simple. Say if you have bought a stock at 100 and now the price is turned to 90. So that 10 rupees is already a loss which has already have been incurred, or it's a sunk cost. Whatever you do on the market, you cry, you laugh, you weep, you dance, nothing will not change. Now the market is pricing it at exactly at 90. If you don't cut it at 90, you're losing. You're not saving up that 10 rupees. That has already have that loss have already incurred. By cutting it 90, what you're doing is you're protecting your capital. Okay. So Concord fallacy is exactly what happened with the British and the French government. They manufactured a Concorde plane, and they realized it very early that this project was not feasible because it was too expensive and nobody will want to fly those planes. But still they keep on investing on that project. And that is what the traders also do. They get into a bad trade. Instead of cutting it or taking a stop loss, they keeps on averaging, or they keeps on adding their position, or they keep on holding their position. The longer you hold, the more risk you are taking. If you want to be a good trader, the best thing you can do, or the first thing you can start with, is get good with stop losses. It is the only way you can survive in this market. See, if your whole horizon or your whole expectation from the market should not be of that you come here for one night stand. The problem with the people or the traders is they think that market is just a quick way to get rich. It is not that way. If you're thinking a career of 5 year, 10 year, 15 years long, couple of losses will not going to impact you. But all you have to do is not to blow your capital. These days, it is very common and it is very what I'll say, celebrated that somebody has lost his whole money and then he did the bounce back. No, there are only less than 2% people who can do the bounce back. The rest of the people, for them, the restart is not that easy. It takes very difficult, and people have. That's why you hear that people equate market to gambling. Why? Because people have lost big money here, and why they have lost big money? The basic reason is of not having a trading psychology. You have to make a trading psychology your best friend. You have to put your more focus on trading psychology. Most of the traders keep on focusing or keep on going to one trainer to another trainer for learning some hack or some God sent indicator which will not work and magically will not give you money. That doesn't work. And I am 15 years into the market. I've read so many books, almost more than 300 books I've read on trading. I've got trained from some of the international trainers, Indian traders I've worked with. I have not seen any trader, good trader, with more than 50 or 60% accuracy level. I'm talking about traders who have made fortune from market. Okay, I'm not talking about somebody who has just started his career. He may have a 80% accuracy level, but somebody who has spent 10 years, he will be very happy and delighted if his 50% of the trades are going in his way. But for him, the risk to reward is more important. His risk to reward would be at least 1:2 and can be as high as 1:7. So if he's taking risk of 1, at least 7 would be his, on the higher side will be his target. Minimum will be 2. So against risk of 1 rupee, he'll be taking a reward of at least 2 rupees. Now coming back to some of the biasness which most of the traders deal with. Even I, as a trader, still 15 years into the market, I still struggle with these biases. One of the most common is confirmation bias. What is confirmation bias? Say we have entered into a trade, and as soon as we have entered into a trade, it is we have taken a long trade and it is showing now the market has dropped a bit and it is showing negative. Okay. So we close the trade, we carry the trade for the next day. The first thing we'll be seeing is whether the Dow is up or not. If the Dow is positive, we'll be giving ourselves a self-confirmation that market will want to recover. Irrespective of the fact that crude may be up 4% and that might be bad for Indian economy and for the Indian market. But because we have long bias, we'll be seeing only one side of the picture, and we'll be only focusing on the Dow, and we'll be ignoring crude completely. That is a confirmation bias. Second, very important and very common with the whole retail side traders is recency bias. Why we say that retailers are the people who are losing money here and the institutions make money is because one of the biggest reason is recency bias. What is recency bias? Recency bias is putting too much weightage on the recent events. What happens in a bull market? People, some of the people have made some money on if the market falls and then bounce back. So people have put too much of weightage that, okay, market will going to bounce back. And as soon as the market reverses, they are stuck. And they are hoping it will going to bounce back. They are giving too much of weightage on the recent event. So that's why we say that retailers get trapped on the up of the market. So in Recency bias, we put too much of focus on the very recent events. So, what happens in the Recency bias? That people happen to buy the top and sell the bottom. Why sell the bottom? Because they, when market is falling, their recent memory or short-term memory is showing them that market will going to continue to fall. Despite of the fact that market has fallen too much, they'll keep on selling. So that's why retailers are the people when we most of the time hear that they have bought the top or they have sold the bottom. Okay. Why institutions do not get stuck in Recency bias? Because their horizon is longer. Their horizon is not couple of days or not couple of weeks. They usually buy, say if a Canadian pension fund is coming or LIC is coming, irrespective of some bad numbers by any bank in one quarter, they'll not be bothered. For them, it will not be a buying opportunity. So they'll be buying the dip. Okay. And if once the prices have reached above their median or above the valuation, they might be selling there or they might be booking profit. And that's the places where the retailers might get trapped. Okay. And they might think there's some operator in the market. There's no operator in the market as such. If I talk about the broader indexes, if I talk about Nifty and Bank Nifty, it doesn't work in, the operator don't operate these indexes. And if the trader is losing money here in these broader indexes, it is only and only their fault. It is only and only their problem. The basic issue is with the trading psychology. Recently, we have seen a very phenomena where people are even borrowing money to get into the stock market. Option has become the new cult. Okay. It is the most easiest or perfect disaster recipe if you're doing that. If you're taking borrowing money and trading into the stock market, you're putting too much of burden on yourself. And any sports, like any other sports, trading is also a psychological sport. You cannot perform under pressure here. If you have a borrowed money, you're bound to fail. You are bound to fail, and there's 99.99% chances that you will be losing that money. Because you'll be coming with that expectation that I have to recover at least the interest cost, I have to recover the finance cost of whatever I'm paying to the bank or the financier, then I have to make the profit. Then you're thinking that you'll be able to succeed in the market. It doesn't work in that way in markets. If you're coming with a borrowed money, it is for sure you'll be losing it all here. To summarize my entire talk, specifically for the newcomers or the people who are struggling to the market, it is specifically highlighting to them and people who are trading. This is not for the people who are investing. This whole highlight of the talk is only for the people who are trading into the market. First thing you have to do is understand whether the market is in trend or whether the market is in sideways. If the market is in trend, then you have to apply the trending indicators. Whether you apply MACD, RSI, stochastics, or any trending indicator, even a super trend will going to work beautifully in a trending market. Only and only 30% of the time market is in trending. So you have to find the stocks which are in trending and trade only and only those stocks. You cannot trade one stock every day and make money in that stock. Okay, so you have to first figure out whether the stock you want to trade is in trending or sideways. If it's there sideways market, there are hundreds of indicators. You apply any mean reversion indicator. So there are two, I'll say, strategies into the market. One is mean reversion and one is momentum or a trend following. So first you have to analyze your own self whether you are a mean reversion trader or you are a trend follower or momentum trader. See, if you're a mean reversion trader, then apply any sideways indicator and try to find out stocks which are in sideways and apply that strategy. It will work beautifully. At least 70 to 80% of your trades can have a good result. Again, I'm saying can have good result because there's always a probability. Similarly, if you have a momentum indicator, you put momentum indicator into anything. Whether currently gold is in a big momentum, you put any momentum indicator on gold, you'll want to see good results. Indian market is in up momentum. It is making all-time high every day. You put any good momentum indicator or any breakout indicator, it will want to give you a good result. So you have to understand or find out the stocks which are in momentum and then apply those momentum indicators. So the first thing is find out what is the temperature or what is the status of that stock. Then start the analysis. Secondly, start working on your psychology. Sunk cost fallacy or the Concord fallacy is the most important thing for a retail trader. Be good or make stop loss your best friend. Unless you don't do that, you can never succeed into the market. See, you have to give stop losses. You should be okay with giving losses, but the whole thing is you should never give a big loss. Smaller losses will never gonna hurt you. That is my guarantee for you. Okay, it is only and only when you have a bigger losses, then that impacts. If you're trading your plan, and as per your plan, there might be 40% trades which may have some losses, and your risk reward is 1:2. I'm sure if you do it for a longer period, that strategy, it'll never gonna fail. So 2 things. First, analyze the market before applying any strategy, whether that market is in trend or whether that particular stock is in trend or sideways. Secondly, work on your psychology. Couple of psychology hack is sunk cost fallacy, recency fallacy, and confirmation biases. These are the 3 most important biases or the fallacies which you have to work on. Then I'm sure you're all going to be profitable if you start following these small tips. Thank you.
मुझे यकीन है कि ये टॉक सुनने के बाद हमारे मन में भी एक जोश उठा है। हम भी अपनी मेहनत की कमाई को इन्वेस्ट करके उसको डबल कर सकते हैं। अब ज्यादा कमाई करेंगे तो खर्चा भी करेंगे। अगर ऐसे ही हर खर्चे पर भी आधा पैसा वापस मिले तो आप फ्लिपकार्ट, मिंत्रा, अमेज़न, नाइका जैसी वेबसाइट पर तो खर्चा करते ही होंगे। कैश करो ऐप पे आपको इन सभी वेबसाइट पर और अन्य 1500 ब्रांड्स पर 50% तक का कैशबैक मिलता है। हमें बस कैश करो ऐप पे जाना है, वहां से फ्लिपकार्ट या अन्य कोई भी ब्रांड सिलेक्ट करना है। हमें हर बार की तरह ही शॉपिंग करनी है, लेकिन इस बार मिलेगा कैशबैक। ये कैशबैक आपके हर शॉपिंग पे मिलेगा और वो कैशबैक होगा सभी ऑफर्स, डिस्काउंट, सेल्स या स्पेशल ऑफर्स के डिस्काउंटेड अमाउंट के ऊपर। ऑर्डर प्लेस करने के बाद ये सारा कैशबैक आपके कैश करो वॉलेट में ऐड हो जाएगा, जो कंफर्मेशन पे आप बहुत आसानी से अपने अमेज़न पे, फ्लिपकार्ट गिफ्ट कार्ड या बैंक अकाउंट में भी सीधा ट्रांसफर कर सकते हैं। तो ये आदत डाल लो, पहले कैश करो पे आओ, यहाँ से किसी भी साइट पर जाओ और अनलिमिटेड सेविंग्स पाओ। तो कैश करो, ऐश करो। Click on the link in description and download Cash Karo app now.